In this video, I'm going to talk about the cash flow statement. This first video, I'm just going to talk about the breakdown of the cash flow statement, and then in subsequent videos, I'll look at the individual components of the cash flow statement. So the first thing that is very critical that can help us to understand is to look at the purpose or the importance of a cash flow. So when you talk of the purpose or importance of the cash flow, is to report or to record on the inflows and outflows of cash. So in other words, the main purpose of the cash flow is to record the inflows and outflows of cash. And we know that the inflows, they result in a plus, and then the outflows result in a minus. But if you look at closely at inflows and outflows of cash, you're basically talking about the bank balance, because when money comes in, it's recorded in the bank. When money goes out, it's recorded in the bank. So in other words, I can say this will help to calculate the cash or bank balance, because inflows naturally go to the CRJ, outflows go to the CPJ. And when you talk of inflows and outflows, or CRJ and CPJ, you're basically talking about the bank balance. So in other words, when someone says cash flow, I'll write here in bold letters, think bank. Right? That's what a cash flow is all about. It's think bank. So basically, we are looking at effects of transactions on the bank account. That's what it talks about. It's effect of transactions on the bank or cash balance. That's what the cash flow talks about. Effects of transactions on the cash or bank balance, because it's inflows and outflows, which is CRJ, CPJ, and that basically talks about the bank account balance. Okay, moving on, we're going to look at the three components of your cash flow, right? Your cash flow is actually, okay, I can call them three or they can be four, depending on how you want to look at it. So the first part of your cash flow is going to deal with cash generated from operations, right? So you're talking of your operating activities, right? It's operating activities or cash generating from operating activities, right? So when you talk of operating activities, right, the first item there, this you need to just know the structure, because this is what you're going to get. The first item when you look at operating activities is going to be cash generated from operations. Now, when we talk of cash generated from operations, we are talking of cash generated from the normal buying and selling activities of the business. So this can be an inflow, but it can also be an outflow. And then you're going to have number two, income tax paid. Income tax paid. Now, this will always be negative because of the word paid. Then you're going to have dividend paid. So your dividend paid as well will always be negative. And then you've got interest paid. Interest paid is also going to be negative because of the word paid. So this one is fairly easy to remember whether you've got an inflow or outflow, because if it's paid, then it's obviously going to be it's obviously going to be an outflow, which is negative. Now, but cash generated from operations, then that one can be positive or negative, depending on whether the business made a profit or they made a loss. That's the first category there. Now, the second category deals with investing activities. So the second one is investing activities. Right? Investing activities are fairly simple to understand. When you're dealing with investing activities, you're basically dealing with non-current assets. right? This is normally non-current assets. The moment you remember that investing activities deal with non-current assets, it becomes easy to know what makes up a part of that. So when you're talking of non-current assets on this side here, we're talking of your fixed or tangible assets, right? And then you're also talking of your financial assets. And in this case, when you deal with grade 12, your financial asset that you deal with is your fixed deposit. Now, the moment you master that, then it becomes easy to know what makes up your investing activities. So the first thing, if I look at my fixed or tangible assets, there are only two things that can happen to tangible assets. You can either buy them or you can sell. So you can have sale of assets. Now, when you sell assets, money comes in. So this is positive. And then the second thing, you can have a purchase of assets. When you purchase assets, money flows out, so it's negative. So remember, when assets are bought, you buy assets, you spend money, it's negative. You sell assets, you receive money, it's positive, right? And then the fixed deposit, you can have an increase in your fixed deposit. So if your fixed deposit increases, it means you've made an investment. So to make an investment, it means you have to take money out of your business and give it to the institution where you're investing. So an increase is negative. And then there's a decrease in fixed deposit. If the fixed deposit decreases, it means there is a maturity. In other words, your money is matured and the money is coming back to you. So it will result in an inflow. So when you're talking of investing activities, sale of assets and a decrease in fixed deposit will result in a positive sign, right? And then purchase of assets and increase in your fixed deposit will result in a negative sign. Okay, and then the last part that we need to deal with is the one on financing, right? It's financing activities. Right? When you talk of financing activities, I want to remind you of what I said in one of the videos. I think it was on the accounting equation when I spoke about sources of funding, and I said sources of funding, it's equity and debt. Those are the only two sources of funding. It's equity and debt. So when you're talking of equity, we're talking of shares. When you're talking of debt, we're talking of the loan. So there are only two things that can happen to shares. You can either issue shares or you can buy back shares, right? And with the loan, you can receive a new loan or you can pay back. So those are the four activities that can happen around your equity or your financing, around your financing. So what does it mean? When I'm doing the cash flow now, so the first thing is I can have issue of shares. If I say issue of shares, it means I'm selling shares. When I sell, money comes in, positive. Or I can have a buyback, okay, someone to call it a repurchase, doesn't matter, repurchase of shares or buyback of shares. If shares are bought back, the company is spending money, so that's negative, right? And then you can have proceeds of new loan. If you get a new loan, it means the bank is giving you money, so money comes into your bank account. And then the last one, it can be a repayment of loan. If you repay a loan, to repay, it means it has to be negative, right? So what does it mean? It means in terms of financing, issue of shares is positive for the bank, money comes in. Buyback of shares, negative for the bank, money goes out. Proceeds from the new loan, positive for the bank because money comes in. Repayment, negative for the bank because the money goes out. Now the only other part of the cash flow that I've not included in this video is going to be cash and cash equivalents, which I'm going to deal with in a separate video because of what has to be addressed in terms of your cash and cash equivalents. Okay, thank you.